If you're sick and tired of getting stopped out on trades just to see them work out in your favor, then this is the video for you. I want you guys to put aside the next 15 to 20 minutes of your life because I can guarantee you it is going to change the way that you trade forever. And if you can't set aside the next 15 to 20 minutes, I don't want to hear you complain that you're not profitable. So if you find value in this video, smash that like button as well as clicking that subscribe and that bell icon. I have 1,500 videos on this channel teaching you on how to trade for completely free. Plus, I live trade every single morning for the first hour and a half of market open. But let's go ahead and let's hop into this video. All right, so I want to start off by saying a lot of traders blame their stop loss either on the algo or the market makers, but 90% of the time, the issue is simple. You're ignoring candle closures. And today I'm going to break this down in a way that actually makes sense. First, what candle closures reveal about buyers and sellers. Second, how they confirm or deny structure. Third, how I use them at supply and demand as well as fib levels. And fourth, how waiting for the close alone can keep you out of so many losing trades. So I want to start off with what does a candle actually show? And I want to start off with a bullish candle. So when we are looking at a bullish candle, what this is telling us is that price closed higher than where it opened, depending on the time frame that we have selected. So right now I have the daily time frame. The candle open is at the lower shaded area. Sometime throughout that candle, price went as low as this lower wick and as high as this upper wick. But at the close of that candle, price close at the upper shaded area. So what this is telling us is that this candle closed higher than where it opened. Buyers were present. Now on the flip side, if we're looking at a bearish candle, price opens at the upper shaded area. Sometime throughout that candle went as high as this upper wick, as low as this lower wick, but by the close of that red candle, price closed at the lower shaded area. So what this is telling us is that price closed lower than where it opened and that this is a bearish candle. So now let's talk about structure. In an uptrend, what you want to see is you want to see price setting higher highs and higher lows. As you guys can tell, I did not get A pluses in art class, nor am I very good at drawing straight lines. That would probably explain a lot about me. But anyways, we would like to see price setting higher highs and higher lows in an uptrend. But what's most important is that price is closing above these previous highs, not wicking above it. We want solid candle closes above previous highs. So a really good example of this, if we head on over here, we can see on the daily time frame of the S&P futures, we get this higher high right here. We pull back, we get a higher low here. This is our previous higher high. So we want to see price actually close above that previous high. If we can get that, that is confirmation that price is likely going to go higher. Typically what happens if we fail to actually break above that previous high and only wick through it, that usually means that liquidity was sitting above the high, smart money filled the positions, and the trend may slow or completely reverse. If price closes above the high, however, now you have a confirmed break of structure and a reason to expect continuation and a potential level for a break and a retest to go long. But the thing is, a lot of traders get faked out because they're buying at the wick as price tries to break above the previous high. But when it fails, because price never closed above, they get stopped out. Now, the same thing goes for a downtrend. In a downtrend, we want to see lower lows, lower highs, and lower lows. I am really bad at drawing. But again, we do not want to see price only wick through the previous low in a downtrend because that's going to signify liquidity grabs. What we want to see is an actual close below that previous low to confirm that more downside is coming. And this one rule alone, I can guarantee you is going to save you a lot of money. Wait for candle closes. Stop buying the breakout or the breakdown. Wait for the candle to actually break and close to confirm a break of structure. Now, before we hop more into this strategy, I want to talk about candle closes within the range. Ranges is where most traders are going to lose money. So say we have this low point right here, this high point right here, and price is just trading in between this range. And actually, I think Thanksgiving Day would be a really good example. So let's pull up Thursday. So here's the price action on Thanksgiving. Obviously, it's given not to trade on Thanksgiving, but in general, if price is trading like this, you want to avoid trading. The reason being, you are likely going to get chopped up and you're going to lose a lot of money if you're trading in chop. So simply put, if the market is chopping, do not trade. Now, the other nice thing about understanding if the market is in an uptrend or in a downtrend is we can try to identify where those higher lows or lower highs are going to be. That way we can look for an entry and trade with the overall trend. But again, what we need to wait for at these pullback areas is confirmation to actually go long or short. So actually a really good example of a trade that I took today on NQ, this trade went up 90 points from my entry. That's where I sold. But I think on this pop up in total, it ran like 120, 130 points. Obviously, I didn't capture the whole 120, 130, but I'm not going to complain about a 90 point trade. So now this is where multiple time frame confirmation is going to come in play. So overall on the day on NQ, I was bullish. Yes, we gapped down a little bit in the overnight session, but if we zoom out to the higher time frame, we are still in an uptrend. All last week, we started running to the upside. We bounced off of a major key level in the market, which was the weekly 21 EMA. So if we zoom out and I put on the weekly 21 EMA, you can see that we bounced right off that area right here. So on the weekly, the overall trend is still to the upside. We come down to it, we bounce off of it with a lot of strength. So on the 1 hour time frame, the overall market was in an uptrend. So we push up, we pull back, we set a new higher high right here, candle close above that previous level. We continue higher. We pull back to another higher low, which happened to bounce off that previous high. And then we break above the previous high. And again, we get candle closes on the way up. Higher low, higher high, higher low, higher high. Tried to gap down, but then we started to reclaim this area and come back up. So overall on the day, I was very bullish. I had no reason to believe that price was going to reject, especially because I had no higher time frame supply zones and I had no higher time frame fib levels. So because all the other higher time frames were bullish, ideally, I was looking for more upside today. And again, we had no reason to believe that price was going to reject. So as the market opened, we chopped for the first 30 minutes because we had news, but eventually we started to make this strong and aggressive move up. Well, we had our previous high over here that we took out and we set a new higher high. So price on a 5-minute time frame is in an uptrend entry. So price on a 5-minute intraday chart is in an uptrend. So what I was looking for was for price to pull back to a higher low to then look for an uptrend entry. So taking a basic Fibonacci retracement from low of day to high of day, this told me to watch price for a pullback into the 50 or 61.8% retracement to go long. And then from there, as price pulls down into this level, we are looking for a reaction to get long. Now, typically when price does trade into my key levels, I'm either watching a 5-minute time frame or a 2-minute time frame for confirmation. So as we can see on these 5-minute candles, neither of them confirmed for me to go long. I mean, this one did, but by the time this 5-minute candle closed, your risk to reward was terrible. So that's why I'll watch a 2-minute time frame, because this allows me to snipe better entries. Now, if we look at this 2-minute candle, well, what do we notice? Price comes down into my key level. We have this very long lower wick right here. It breaks below the 61.8% retracement, bounces back up, reclaims it. And this is what I want you guys to really make note of. Yes, it's a red candle. Yes, we have red volume as well, but you need to understand, what did we just trade into and what is the overall higher time frame trend entry to the upside, right? So at one point, this was a solid red candle. It looked something just like this. But as we traded into this key level, the buyers came in and they pushed price higher and we closed all the way up here. So it is very clear that buyers are present at this 61.8% retracement. Now, if we look at this 2-minute volume, well, this is the highest volume we had since way over here. So again, to us, it is very, very clear that buyers are present. And this is exactly what you want to see when we trade into key levels. So as I started to notice this reaction, price came up, started to close above this 61.8% retracement. That is when I went long, stop loss right below this low, and I was able to capture this move up into high a day. Again, that is a very good example of what you should look for when we trade into key levels, as well as piecing that together with the higher time frame trends. And even if you were just looking at a 2-minute trend entry today, what do we notice? Higher high, higher low, higher high, higher low, higher high, higher low, higher high, until eventually the trend reversed and it started to pull back on the 2-minute time frame. But again, once we start to zoom out, even a 30-minute is going to show us that we are still in an uptrend. higher high, higher low. So what I would like to see tomorrow, ideally, again, because we don't have any supply or reject zones, is for price to go and set a new high. Or another trade that I took last week, or another really good example right here on the NASDAQ futures. Again, we'd previously bounced off of that weekly 21 EMA, so the weekly time frame was in a very strong uptrend. All it did was pull back, set that higher low at the weekly 21 EMA, and then just breaking it down to a 5-minute time frame. We see the previous day, higher high, higher low, higher high. We consolidate in the pre-market session, and then eventually as the market opens, we break above the previous day's high. So again, the weekly time frame is in an uptrend. The 5-minute time frame is now officially in an uptrend. So what are we looking for from there? We are looking for price to pull back to that previous high or any other potential uptrend entry, which in this example, you could have also used the Fibonacci retracement. Again, this is a trade that I took. Price pulls back. It pulls back into that previous day high, which was that previous high for the uptrend. Price pulls back to the previous high, as well as the 61.8% retracement, breaking it down to a 2-minute time frame. Look at this 2-minute candle right here. Again, this is a very clear sign that price is bullish. Long lower wick, bullish candle, dragonfly doji, elevation in the volume right off of our key level. This is the highest volume since the first 6 minutes of market open. Typically the first 5 minutes is going to have the most amount of volume. So that is a very clear sign that buyers are present at that previous high, as well as the 61.8% retracement. So again, at the close of this 2-minute candle, because remember, at one point, this candle was a solid red candle, just like this. But by the end of those 2 minutes, buyers came into the market, they drove price higher, and we have this long lower wick right off of our key level. Again, don't enter halfway through the candle, enter at the candle close. Because what's going to happen if you enter halfway through the candle, there's still another half of the candle where it could completely unconfirm the setup that you are watching. So wait for the candle to close. When that candle closes and it gives you proper confirmation, that is when you enter the trade and your stop is on the opposite side of the confirmation candle. So again, this would have been your long entry at the close of this 2-minute candle. And as we can see from there, price had a very large and aggressive move to the upside. I think it actually went way higher than this that day. So again, I know this sounds very cliche, but trading is actually pretty simple as long as you know what to look for and you actually wait for confirmation. Again, most of my entries are validated on a 5-minute or a 2-minute time frame. It just depends on which one confirms best, because sometimes the 2-minute's not going to confirm, but the 5-minute does. Sometimes the 5-minute won't, but the 2-minute will. So again, play around with those 2 different time frames. But when we trade into key levels, higher time frame key levels of supply and demand and fibs, if you don't know how to draw those, I will be leaving links to those down in the description. Highly suggest you guys watch those videos because that is the root of how I trade. But learn how to plot supply and demand as well as fibs. Understand the overall trend. Are we in an uptrend or are we in a downtrend? Because that's going to help intraday trading and make it so much easier. And when we trade to those key levels, again, wait for candle closes and confirmation at those key levels. So if you guys did find value in today's video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. By following this simple strategy, that's how you're going to increase your win rate. Guaranteed. Test it out, come back to this video in a few weeks and comment down below how it went. Everybody have an amazing rest of your day, and I'll see you guys in the next video.